America did not create the Federal Reserve because it wanted to. It created it because the country was scared. In 1907, banks collapsed in days, not months. People lost savings overnight. The government stood still, powerless to stop it. One private banker held the system together while Congress watched. When the panic ended, one truth was clear. If fear struck again, America would not survive on luck. Something permanent had to be built. In 1913, the United States made one of the most important decisions in its financial history. It created the Federal Reserve. The decision did not come from ambition. It came from fear. Fear born from decades of financial chaos. Fear sharpened by repeated panics. Fear confirmed by the near collapse of 1907. The Federal Reserve was not designed to make America rich. It was designed to stop America from breaking itself. For more than a century after independence, the United States resisted the idea of a central bank. The memory of British control still lingered. Power concentrated in financial institutions felt dangerous. Many Americans believed central banking favored elites and threatened democracy. This distrust shaped early American policy. The first Bank of the United States was controversial. The second bank was destroyed by political force. What followed was not freedom. It was instability. Throughout the 19th century, American banking operated without a central anchor. Thousands of banks issued their own notes. Credit expanded and contracted unpredictably. Booms were frequent. Busts were devastating. Every generation experienced financial panic. Each panic followed the same pattern. Speculation expanded during good times. A shock arrived. Confidence vanished. Banks failed. Businesses collapsed. Workers lost jobs. Recovery took years. By the late 19th century, the American economy had grown too large and too complex for this cycle to continue safely. Railroads connected national markets. Corporations operated across state lines. Finance became interconnected. A failure in New York rippled across the country. Yet the banking system remained fragmented. There was no institution responsible for stability. No lender of last resort. No coordinated response. The panic of 1907 exposed this weakness more clearly than any previous crisis. The system did not fail because America lacked wealth. It failed because it lacked structure. Liquidity dried up not because money disappeared, but because no one could access it quickly. Trust evaporated because there was no authority capable of restoring confidence. In the aftermath of the panic, Congress could no longer ignore the problem. The public demanded answers. Why had one private banker been forced to save the nation? Why had the government been powerless? Why did the system collapse so easily? Investigations began almost immediately. Committees were formed. Experts were summoned. The search for reform started slowly, then gained momentum. One of the most influential responses was the creation of the National Monetary Commission in 1908. Its mission was simple and enormous. Study financial systems around the world. Identify why America's system failed. Propose a solution that fit American political realities. The commission traveled to Europe. It studied central banks in England, France, and Germany. What it found was unsettling. European economies were not immune to crisis, but they handled panic differently. Central banks acted as stabilizers. They injected liquidity during stress. They coordinated banks. They calmed markets by their mere presence. Panic still occurred, but it rarely destroyed the system. America lacked this stabilizing force. Yet importing a European-style central bank was politically impossible. Americans feared concentrated financial power. Wall Street influence alarmed farmers, workers, and small banks. Any reform would face resistance. The solution had to appear decentralized while functioning centrally. It had to balance power, not concentrate it openly. The debate over reform exposed deep divisions. Some argued for a single powerful central bank. Others wanted regional control. Some feared inflation. Others feared deflation. Behind every argument lay political interest. Banks wanted protection. Farmers wanted credit. Industrialists wanted stability. No one trusted anyone else. The breakthrough came quietly, in secrecy. In 1910, a small group of bankers, economists, and lawmakers met at Jekyll Island, off the coast of Georgia. The meeting was private by design. Participants used first names only. They traveled discreetly. The goal was to draft a plan that could survive political attack. What emerged was a compromise disguised as complexity. The Federal Reserve would not be one bank. It would be a system. 12 regional Federal Reserve banks would serve different parts of the country. A central board would coordinate policy. Power would be shared. Authority would be layered. This structure reassured skeptics while enabling control. The proposed system aimed to solve three critical problems exposed by past panics. First, it would provide elastic currency. Money supply could expand during crises and contract during normal times. Second, it would act as lender of last resort. Banks facing temporary stress could access emergency funds. Third, it would coordinate the banking system, preventing isolated failures from triggering nationwide collapse. Debate continued fiercely. Critics warned of inflation. Others warned of Wall Street dominance. Supporters argued that the cost of inaction was higher. The memory of 1907 remained fresh. Fear became a persuasive force. In 1913, after years of debate, Congress passed the Federal Reserve Act. President Woodrow Wilson signed it into law. The United States finally had a central bank, though few called it that openly. The Federal Reserve began operations in 1914, just as the world descended into war. The timing mattered. World War I tested the new system immediately. The Federal Reserve helped finance the war effort. It stabilized bond markets. It coordinated banks. The system proved its value quickly. Confidence grew. Over time, the Federal Reserve's role expanded. It became responsible for managing interest rates. It influenced inflation and employment. It evolved through crises, learning through failure and reform. The Great Depression exposed flaws. New powers followed. Each crisis reshaped the institution. The Federal Reserve did not eliminate panic. It changed how panic was handled. Instead of collapsing inward, the system now had tools to respond. Liquidity could be injected. Confidence could be signaled. Time could be bought. This story matters because the Federal Reserve remains one of the most powerful institutions in America. Its decisions affect mortgages, jobs, markets, and government debt. Yet it was not created by theory alone. It was created by fear. By failure. By the realization that modern economies cannot survive without coordination. The Federal Reserve exists because America nearly lost control of its financial system. It exists because private power proved insufficient. It exists because trust needs structure to survive stress. Every time the Federal Reserve acts during a crisis, it echoes 1907. Every emergency facility reflects lessons learned from panic. Every debate about inflation or independence traces back to the same question. Who should control money when fear takes over? The creation of the Federal Reserve marked America's transition from financial adolescence to institutional maturity. It did not solve every problem. It did not remove risk. It did something more important. It gave the system a center. If this story made you pause, this channel is for you. Here, you don't get headlines or noise. You get the real financial history of America, told as stories, step by step, so you understand how money, power, and decisions shaped the country you see today. Every video breaks down one moment that changed the system, why it happened, and why it still matters to your life now. Subscribe Dollar Story. If you want clear history, no hype, and honest explanations of how America's financial past still controls its future.